The Federal Reserve just lowered interest rates again, but the signals they're sending along with this action point to a deeper problem. Yes, a third rate cut for 2025, this is supposed to ease financial pressure, right? But the Fed is gingerly stepping off the gas while simultaneously telling us, hold on, don't expect too much relief next year. What does this really mean for the economy? And more importantly, why should we care? Let's dissect the layers of economic issues here, from their immediate effects on the stock market to their long-term impact on inflation, jobs, and consumer confidence. We're seeing a pattern, one that doesn't bode well for the economy. The Federal Reserve lowered its benchmark interest rate by a quarter point, moving it to a range of 4.25% to 4.5%. But here's the catch, they are signaling slower cuts in 2025. Now, don't mistake this for optimism. In fact, the Fed is basically admitting that despite a resilient labor market and some economic growth, inflation remains sticky and above their target, lingering at 2.5% in 2025, up from previous forecasts of 2.1%. What we're dealing with here is admission of defeat, or at the very least, acknowledgement that they're stuck in a tricky situation. Why would the Fed want to slow the pace of rate cuts? Caution. They're worried. While inflation has come down from its peak, it's still above what the Fed feels comfortable with. Meanwhile, unemployment might increase to 4.3% in 2025, but we aren't in a recession, yet. There's a balancing act between controlling inflation and not crashing the labor market. It's like the Fed is walking a tightrope, too loose, and inflation eats away at purchasing power, too strict, and job losses spike. The S&P 500 dipped following the rate cut announcement. Now, financial markets hate uncertainty, and let's be clear, the Fed just injected even more of it into the system. The Fed's move caused the 2-year Treasury yield to jump, hitting its highest rate since November, signaling that investors are bracing for a more prolonged period of higher rates. These kinds of reactions reflect just how much anxiety is baked into the markets right now, especially when it comes to expectations about inflation and economic growth. Now remember, higher bond yields spell trouble for businesses looking to borrow. Companies that were already stretching their financing during times of higher interest rates are feeling the pinch. So when we see stock indexes like the S&P 500 fall as soon as the Fed signals more caution, it begs the question, are investors just the early canary in the coal mine? More challenges for businesses mean slower hiring, possibly more layoffs, and tighter consumer spending. The trickle effect on wage growth will follow, leading us into the real problem here. Here's where things take a deeper dive. The Fed's revised inflation forecast of 2.5% by the end of 2025 is troublesome. Why? The Fed is supposed to keep inflation at around 2%, and the fact that we're not expected to hit that target in the near term begs a different set of questions. After all, what is keeping inflation high? And why is the Fed, with all its tools, still left managing above target inflation? Some of it, of course, ties back to supply-side shocks that aren't fully resolved. Look at housing, a cost driver that's still going up, not down. Despite Fed hopes that housing prices will relax, rent costs have remained stubbornly high. And beyond that, global uncertainties remain, for example, Trump's talk about tariffs, immigration controls, and corporate taxation, issues that could very well spike inflation further, forcing the Fed's hand once again. And let's not forget oil prices. Energy costs have stabilized somewhat from insane highs, but they're still volatile. Any further strain in the global supply chain, whether it's a new pandemic variant, new geopolitical tensions, or even climate-induced production challenges, could spark another wave of supply-side inflation. If consumers can't keep up with rising costs, purchasing power erodes further. For those who closely monitor the labor market, the Fed's acknowledgments about downside risks are equally concerning. There's been commentary that while the unemployment rate has risen to 4.2%, it's still fragile. This is because the average payroll growth over the last few months, 173,000 jobs, is a sign of slowing momentum. Think about it, much of the economic recovery after COVID was driven by a robust labor market, which fueled consumer spending. If that engine starts sputtering, what then? Unemployment is expected to edge up to 4.3% in 2025, and while that's not catastrophic, it does highlight an overall slowing in job creation efforts. This is a problem. The Fed is relying on corporate confidence to stabilize, but many industries are scaling back hiring or at least slowing down growth. Remember, this comes as debt obligations become more expensive due to this high interest rate environment. The slowdown in hiring is an early indication that corporations are preparing for tighter times. Even giant tech companies that thrived during the pandemic boom are now more cautious. Think about recent layoffs at companies like Amazon and Meta. With inflation so persistent and the labor market in flux, we can't rule out a very dangerous economic scenario, stagflation or even worse, a recession. Let's break this down in simple terms. The Fed's caution on rate cuts means that businesses and consumers alike face rigid credit conditions. Inflation, while moderating, isn't falling fast enough to dig us out. We're stuck in a twilight zone, neither growing nor shrinking fast enough to make clean policy decisions. Politically, it's a messy space. President Trump's incoming proposals on tariffs, immigration, and possibly corporate tax changes add even more volatility to the outlook. For example, more aggressive tariffs on China or renewed trade wars could lead to higher prices for goods, forcing inflation to remain high. Likewise, immigration restrictions could squeeze the labor market, dampening growth and pushing wages even higher, which responsible employers can't always support. Now, one interesting shift in the Fed's behavior this time around has been its change in the neutral rate. For those of you unfamiliar, the neutral rate is essentially a point where rates neither stimulate nor restrain the economy. The pandemic has clouded where exactly this rate is, and some experts now believe the neutral rate is higher than pre-COVID times. But guess what? This means the Fed has less room to cut rates before they start stimulating excessive inflation. Fed officials bumped their estimate of this neutral rate to 3%, signaling that inflationary risks are higher, while policy tools are less effective. If we're trapped in a scenario where the Fed shouldn't go much below 3%, we'll be in a high-interest rate ecosystem for longer than many expect. This style of policy tightens financial conditions across the board, hurting startups, small businesses, and the lower to middle class, the very engines of economic dynamics. What we're seeing is profoundly worrying, not just for the coming years but potentially the next decade. To wrap it up. 1. The Fed's rate decisions reflect deep caution. Despite the cuts, inflation remains pressured, and the employment narrative may soon change as companies scale back growth expectations. 2. Stock markets and treasuries are reacting to unresolved issues in the economy, signaling a more persistent period of high interest rate pain that could slow investments. 3. Corporate hiring and wage growth are softening, and with unemployment expected to rise, which means even more uncertainty in the labor market. 4. Persistent inflation risks and global instability, particularly around future U.S. policies like tariffs and corporate taxes, could exacerbate economic disparity. 5. The Fed's neutral rate adjustment means cutting interest rates won't be as easy as it used to be, and we may be in for a prolonged period of high rates trying to balance growth and inflationary pressures. In a nutshell, the Fed is saying, we're navigating uncharted waters. Today's cautious tone speaks volumes about how fragile our economy is, still recovering from the scars of the pandemic, yet entering stormy geopolitical and inflationary seas. Whatever happens in the next few years, it's clear that this is a bumpy road for U.S. monetary policy, global financial markets, and most critically, American households. We've been here before. But this time, the stakes seem higher. Prepare yourself, the economic ride ahead won't be smooth.